Hold a gold coin in your hand. Feel its weight, its density, the way light plays across its surface. That metal in your palm is the same substance ancient Egyptians treasured 5,000 years ago, the same element Roman emperors minted into coins, the same material that built empires and survived their collapse. Gold is chemically inert. It doesn't rust, doesn't corrode, doesn't decay. 1 gram of gold today is identical to 1 gram of gold from antiquity. This is purity. This is permanence. This is the truth in physical form. Now imagine the opposite. A currency made of nothing, numbers on screens, backed by nothing but promises from institutions that have broken every promise they ever made. Money that governments can create infinitely with no limit, no constraint, no connection to anything real. Money that loses value every single day you hold it, transferring your wealth to those who create it first. This is the story of that corruption. This is how gold's unchanging purity exposes the greatest monetary crime in human history. For millennia, gold served as humanity's monetary anchor because it possessed unique properties no government could manipulate. You cannot print gold. You cannot decree more gold into existence. You cannot debase it by mixing it with cheaper metals without detection. Its supply grows slowly, predictably, through the arduous work of mining. These constraints forced discipline on rulers. When your money was gold, or backed by gold, you could only spend what you actually had. But human nature being what it is, every civilization eventually attempted to cheat. The Romans perfected this art, transforming monetary debasement into a science that would doom their empire. The modern world has taken that Roman playbook and amplified it to scales the Caesars could never have imagined. We're living through the final act of an experiment that began when the last link between money and gold was severed. And the evidence of its failure is mounting everywhere you look. The story begins in ancient Rome, because Rome's monetary collapse is the template for every currency disaster that followed. In 211 BC, Rome introduced the denarius, a silver coin containing approximately 4.5 grams of pure silver. For centuries, it held near that standard. When a Roman citizen received a denarius, they knew roughly what they possessed. The coin's weight, its purity, its value remained relatively constant. This created trust. Markets flourished. Trade expanded. Rome's economy thrived on the solid foundation of honest money. But empires are expensive. Every generation, Rome's borders expanded. Every expansion required more soldiers, more forts, more roads, more administration. The legions needed to be paid. The bureaucracy needed to be funded. And eventually, Rome faced a problem every empire encounters. They were spending more than they earned. So Emperor Nero, ruling from 54 to 68 AD, made a decision that would echo through the centuries. In 64 AD, he ordered the mints to reduce the silver content of the denarius. Historical evidence suggests he cut it by roughly 10%, bringing purity down to around 90%. Think about what this meant. The government was claiming that a coin with less silver was worth the same as a coin with more silver. They could mint 11 coins with the silver that previously made 10. More coins in circulation meant the emperor could pay his bills without raising taxes. It seemed like magic. Free money from nowhere. But it was theft. Every existing coin lost 10% of its value overnight. Still, 90% silver was substantial. The real destruction came later. By the time Emperor Caracalla ruled in 211 AD, the denarius had fallen to roughly 50% silver. Half real value, half base metal. The government's claim that nothing had changed became harder to believe. By 265 AD, under Emperor Gallienus, historical records indicate the denarius contained just 5% silver. A coin that was once nearly pure silver was now 95% worthless copper with a thin silver coating that wore off quickly, revealing the fraud underneath. The economic consequences were catastrophic. What cost 1 denarius in 200 AD required 50 denarii by 300 AD. A 50-fold price increase. Soldiers realized they were being paid in worthless metal and refused to fight unless compensated in gold. Farmers stopped accepting denarii for food and demanded barter instead. Tax collectors couldn't collect taxes because the currency was worthless. The entire economic system seized up, not because Rome's military had weakened, not because barbarians had grown stronger, but because the government destroyed its own money. By 476 AD, the Western Roman Empire collapsed. Historians often attribute this to Germanic invasions, but the tribes that overran Rome weren't militarily superior. Rome simply couldn't pay its armies anymore, couldn't fund its administration, couldn't maintain its infrastructure. The currency had been debased into irrelevance, and everything built on that currency collapsed with it. This pattern, once you see it, becomes impossible to ignore. Every great empire that debases its currency follows Rome into the dust. Now leap forward 12 centuries to a time when people had supposedly learned from history's mistakes. The gold standard emerged gradually, with Britain effectively operating under a de facto gold standard as early as 1717, when Isaac Newton, as master of the Royal Mint, set silver-to-gold ratios that drove silver from circulation. But Britain didn't formally adopt the full gold standard until 1821, establishing the world's first true gold specie standard where the monetary unit tied directly to circulating gold coins. Other nations watched and followed. By the 1870s, most advanced economies had adopted the classical gold standard. This wasn't just about using gold coins. It was an entire system of monetary discipline. Under the gold standard, governments fixed their currency values to specific amounts of gold. Britain defined the pound sterling as a quarter ounce of gold. The United States set the dollar at 1/20th of an ounce. These weren't suggestions. They were legally binding commitments. If you held paper currency, you could walk into a bank and demand gold at the fixed rate. This created an automatic stabilizing mechanism. If a government tried to print too much paper money, people would redeem it for gold, draining the government's gold reserves and forcing monetary restraint. The results were remarkable. From 1880 to 1914, the era of the classical gold standard, average annual inflation was approximately 0.1%. Not 10%, not even 1%, roughly 1/10 of 1%. Prices remained relatively stable for a generation. Compare that to the period from 1946 to 2003, after the gold standard was abandoned. Average annual inflation rose to around 4.1%. That's 40 times higher. The gold standard delivered precisely what sound money should deliver: long-term price stability, predictable value, an economic foundation people could trust. But the gold standard had one crucial feature that governments hated. It limited their power. You couldn't finance wars with printed money. You couldn't buy votes with government spending you couldn't afford. The gold standard was a straitjacket on political ambition. And when World War I erupted in 1914, governments across Europe suspended gold convertibility so they could print unlimited money to fund the war. They promised it was temporary. They said they'd return to gold after the emergency. They were lying. The interwar period saw brief attempts to restore gold backing, but the discipline it required proved too difficult. Britain tried returning to gold in 1925 at pre-war rates, which overvalued the pound and crushed the economy. France and the United States maintained varying degrees of gold backing through the 1930s, but the system was dying. World War II delivered the final blow to the classical gold standard. By 1945, most currencies were barely connected to gold at all. The Bretton Woods Conference of 1944 created a new system. The United States, holding most of the world's gold after the war, promised to maintain gold convertibility at $35 per ounce. Other nations pegged their currencies to the dollar, making the dollar the world's reserve currency. This wasn't a true gold standard anymore. It was a dollar standard with a gold window, and that window was about to slam shut. The date was August 15, 1971. President Richard Nixon appeared on television to address the nation about his new economic policy. The Vietnam War was hemorrhaging money. The Great Society programs were draining the treasury. Foreign governments, especially France, were demanding gold in exchange for their dollars. They'd noticed the United States was printing far more dollars than it had gold to back them. The bluff was being called. Nixon announced that the United States would temporarily suspend the convertibility of dollars into gold. Temporarily. That word is crucial. The administration presented this as an emergency measure, a short-term fix to be reversed once they'd reformed the system. No major policy change was being made. Nothing fundamental had shifted. Just a temporary suspension. It was all a lie. The gold window never reopened. What followed over the next few years was a series of failed attempts to maintain fixed exchange rates without gold backing. The Smithsonian Agreement of December 1971 tried to rescue Bretton Woods by devaluing the dollar and adjusting exchange rates. It lasted 15 months before collapsing. By 1973, the major currencies were floating freely against each other, backed by nothing except government promises. The era of pure fiat currency had begun. Fiat money means money by decree. The Latin word fiat translates as "let it be done." Fiat currency exists because governments declare it exists. There's no gold backing it, no silver, no commodities, no physical asset of any kind. Just the government's promise that the paper in your wallet has value. And once you remove the gold anchor, governments face an irresistible temptation. If we can create money from nothing, why not create as much as we need? The initial effects weren't immediately catastrophic. Through the 1970s, inflation did surge into double digits, forcing Federal Reserve Chairman Paul Volcker to raise interest rates to brutal levels in the early 1980s to restore some semblance of price stability. But the 1980s and 1990s saw relatively moderate inflation, at least by the official measures. People began believing that modern central banking had somehow solved the problems that plagued fiat currencies throughout history. We were different. We were smarter. We had sophisticated models and PhD economists. The old rules didn't apply. Then came 2008. The global financial system teetered on the brink of complete collapse. Major banks failed, stock markets plummeted, credit markets froze. Millions lost their homes and jobs. Governments and central banks panicked. Their response would accelerate the monetary corruption to unimaginable levels. Central banks unleashed quantitative easing, a term that sounds technical and benign but means something very simple: creating money from nothing. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, all began buying government bonds and other assets with newly created digital money. Not printing physical currency, just typing numbers into computer systems, creating electronic deposits that multiplied the money supply exponentially. The scale was staggering. From 2008 to 2023, central banks created over $25 trillion through quantitative easing programs. The stated goal was to inject cash into the economy so banks would lend more, businesses would invest, and economic recovery would follow. It sounded reasonable. It was sold as helping ordinary people. The reality was very different. Most of that newly created money never reached the real economy. It stayed trapped in financial markets. Banks used it to buy stocks, bonds, and real estate. Investors watched their portfolios soar while wages for ordinary workers barely moved. Stock markets hit record highs year after year. Housing prices doubled, then tripled in many cities. Billionaires multiplied their wealth, while first-time homebuyers found themselves permanently priced out of the market. A 2012 Bank of England report revealed what many suspected but few wanted to admit. Its quantitative easing policies had benefited mainly the wealthy. 40% of those gains went to the richest 5% of British households. The mechanism was simple. When central banks create money to buy assets, asset prices rise. Who owns assets? The wealthy. Who owns almost no assets? Everyone else. This wasn't accidental. This was the inevitable result of the policy. In the United States, the wealth concentration statistics tell the story starkly. As of recent measurements, the top 1% of Americans own 32% of all wealth. The bottom 50%, half the population, own just 2%. This isn't speculation or exaggeration. These are the official numbers, and quantitative easing accelerated this divergence dramatically. The mechanism economists call the Cantillon effect explains why. When new money enters the economy, it doesn't arrive evenly distributed. It enters through specific channels, primarily banks and financial institutions. Those who receive this money first can buy assets before prices rise. They benefit fully. By the time the money works its way through the economy to reach ordinary workers in the form of wages, prices have already increased. The purchasing power of each dollar has eroded. The first receivers extract real wealth. The last receivers get devalued currency. Meanwhile, central banks drove interest rates to near zero, sometimes even negative in Europe and Japan. This destroyed the returns available to middle-class savers. Before 2008, you could park money in a savings account or money market fund and earn 4 or 5% annually. After quantitative easing, those same safe investments yielded essentially nothing. A typical money market fund in 2007 yielded 4.46%. By 2020, it yielded 0.01%. Think about what this means for someone trying to build wealth through saving. You're being punished for thrift. Your savings generate no return, while inflation eats away at their purchasing power. You're forced into riskier investments, stocks and real estate, just to prevent your wealth from evaporating. But most people don't have enough capital to meaningfully invest. They're living paycheck to paycheck, watching prices rise while their wages stagnate. The system is deliberately designed to push them further behind. The truly remarkable aspect is how openly this was admitted. Federal Reserve Bank of Dallas President Richard Fisher stated in May 2013 that cheap money has made rich people richer, but hasn't done quite as much for working Americans. This wasn't a critic speaking. This was a Federal Reserve official acknowledging the distributional effects of the policy while defending it as necessary. The logic went like this. We had to save the financial system. Saving the system required inflating asset prices. Inflating asset prices benefits asset owners. If you don't own assets, that's unfortunate. But the alternative would have been worse. Perhaps the alternative would have been worse. Or perhaps allowing bad banks to fail, allowing asset prices to find their natural level, would have created short-term pain but long-term health. We'll never know, because that path wasn't chosen. Instead, governments and central banks chose to inflate their way out of the crisis. And inflation always transfers wealth from the many to the few. Here's what makes the current moment fascinating and terrifying. Central banks themselves are returning to gold. Not publicly, not with any fanfare, but the numbers tell a story their public statements try to obscure. Central banks added over 1,000 tons of gold to their reserves in 2022, marking the highest level since 1967. Then over 1,000 tons again in 2023. Then over 1,000 tons again in 2024. 3 consecutive years of massive accumulation at a pace not seen in modern history. The National Bank of Poland has been particularly aggressive, adding 67 tons of gold in the first 8 months of 2025, bringing its total reserves to approximately 515 tons. Poland's central bank president has openly stated the goal of raising gold's share of reserves from 20% to 30%. India's Reserve Bank brought 100 tons of gold back from London to store domestically in 2019. China continues buying steadily, though many analysts believe actual holdings exceed official reports significantly. Survey data from the World Gold Council's 2025 Central Bank Gold Reserve Survey reveals even more. When asked, 95% of central bankers expect global gold reserves to increase over the next 12 months. 43% plan to increase their own institution's gold holdings, a record high. Notably, none of the respondents anticipated decreasing their gold reserves. The reasons they cite tell you everything. Performance during times of crisis, long-term store of value, protection against inflation, hedge against geopolitical risk. Meanwhile, the same central banks publicly dismiss gold's monetary role. Federal Reserve chairs routinely testify that gold is merely a tradition, a barbarous relic from an earlier age with no place in modern monetary systems. If that's true, why are they hoarding it? If gold has no monetary value, why do central banks collectively hold over 36,000 tons of it? Why are they repatriating gold from foreign storage, moving it back to their own vaults where they can physically control it? The answer becomes clear once you examine the pattern. Central banks understand fiat currency is fundamentally unstable. They recognize that every fiat currency in history has eventually collapsed. The average lifespan of a fiat currency, based on historical analysis, appears to be around 27 to 30 years. We're now 54 years into the current experiment, twice the historical average. The strains are showing everywhere. Consider the mathematics of the current system. Money enters existence as debt. When banks make loans, they create deposits. Those deposits are the money supply, but the loan comes with interest attached. If the money supply equals $100, but the debt including interest totals $110, where does the extra $10 come from? It doesn't exist. Mathematically, it's impossible for everyone to repay their debts. Someone must default, must borrow more, or the money supply must expand further. This is perpetual motion toward instability. Inflation isn't a bug in this system. It's a feature. When you create more money than goods and services, prices must rise. That's not opinion. That's arithmetic. Since 1971, when Nixon closed the gold window, the dollar has lost 98% of its purchasing power, according to multiple analyses of currency depreciation. What cost $1 in 1971 requires over $30 today. This isn't gradual decline. This is systematic destruction. And the pace appears to be accelerating. The wealth transfer this creates is staggering. If you held dollars in 1971 and just saved them, you lost 98% of your wealth measured in purchasing power. If you owned real assets like stocks, real estate, or commodities, you benefited as nominal prices rose. The system rewards asset owners and punishes savers. It rewards speculation and punishes thrift. These aren't accidental outcomes. They're the inevitable consequences of separating money from any anchor to physical reality. Gold exposes this corruption by existing as the control group. Gold's purchasing power has remained relatively stable over very long time periods. Historical accounts suggest an ounce of gold in ancient Rome could buy a fine toga and sandals. An ounce of gold today buys a quality suit and shoes. The goal didn't change. The measuring stick, fiat currency, changed. Gold holds a mirror up to fiat money and reveals its debasement. When you measure gold against the expanding fiat money supply, a strong correlation emerges. As central banks created more dollars, euros, yen, and pounds, gold's price in those currencies rose proportionally. From 2000 to 2025, gold has delivered approximately a 1,075% return. Not because gold became more valuable, because currencies became less valuable. Gold is the constant. Fiat is the variable. This is why governments and central banks have a complicated relationship with gold as a monetary standard while simultaneously hoarding physical gold. They understand its properties perfectly. They recognize it cannot be inflated away. They know it imposes discipline they don't want. But they also understand it will likely hold value when fiat currencies fail. So they accumulate it privately while telling the public it's irrelevant. The pattern has been tested repeatedly throughout history, and the results point in the same direction. Rome debased the denarius from nearly pure silver to roughly 2% silver. The currency died. The empire followed. Spain flooded Europe with New World silver, creating inflation that contributed to destroying Spanish power. Britain abandoned gold in 1931, and the pound collapsed from being the world's reserve currency to being just another fiat currency within a generation. The United States left gold in 1971, and the dollar has lost 98% of its purchasing power since. Every major central bank now runs the same playbook Rome ran. Spend more than you have. Create money to cover the difference. Claim inflation is transitory. Raise rates too late. Create new crisis. Create more money to solve that crisis. The cycle accelerates until it can't. We're watching this in real time. Government debt levels across the developed world have reached levels previously seen only during world wars. The United States federal debt exceeds $36 trillion and rises by more than $1 trillion every 3 to 4 months. That's not a crisis forecast. That's happening now. Servicing that debt requires spending that exceeds tax revenues. The gap must be filled either through more borrowing or more money creation. Both accelerate the problem. Interest payments on government debt are consuming ever larger shares of budgets. As debt compounds and interest rates rise even modestly from historically low levels, these payments spiral upward. At some point, mathematically, either taxes must rise dramatically, spending must be cut drastically, or the debt must be inflated away through currency debasement. History suggests governments always choose inflation. It's the politically easiest option because most people don't understand they're being robbed. This is where gold's role becomes critical. Gold has no counterparty risk. It doesn't depend on anyone's promise. It doesn't require trust in institutions. It simply exists as elemental reality. You cannot decree gold into existence. You cannot print it, inflate it, or debase it. These properties made it money for 5,000 years, and these same properties make it the ultimate protection against monetary debasement today. When you hold gold, you hold something that every central bank in the world recognizes as valuable, even if they publicly claim otherwise. When fiat currencies wobble, gold steadies. When governments overspend and currencies debase, gold holds value. When trust in institutions erodes, gold remains. This isn't theory. This is what's happening now. Look at what central banks are doing, not what they're saying. They're accumulating gold at the fastest pace in history while telling the public gold is irrelevant. They're repatriating gold from foreign storage while insisting currency systems are stable. They're surveying each other and unanimously expecting gold reserves to increase while claiming gold has no monetary function. The contradiction couldn't be more obvious. You're faced with a choice. Believe the words or believe the actions. Trust the promises or trust the precedents. Accept that this time is different, or recognize that the pattern has repeated throughout history and is repeating again now. Every empire that debased its currency collapsed. Every fiat currency eventually fails. Every central bank knows this, which is why they're buying gold. The system cannot afford for you to be debt-free. It cannot function if people hold assets outside the financial system. It depends on your participation, your borrowing, your belief that the digits in your bank account represent something real. But those digits are claims on a currency that loses value by design. Real wealth exists outside that system. Land, resources, skills, productive assets, and yes, gold. Understanding this doesn't make you paranoid. It makes you informed. The largest wealth transfer in human history is happening now, moving purchasing power from anyone holding fiat currency to anyone holding real assets. This transfer accelerates as money creation accelerates. The more desperately governments and central banks try to maintain the illusion, the faster the reality catches up. Rome took centuries to fully debase the denarius. The process started under Nero in 64 AD and concluded with worthless copper coins by 300 AD. Modern technology allows the same debasement to happen in decades instead of centuries. The speed masks the pattern, but the pattern remains identical, first gradually, then suddenly as currencies approach their intrinsic value, which is zero. Gold's purity exposes money's corruption not through argument, but through existence. It stands as the permanent comparison point, the unchanging reference against which all fiat currencies are measured and found wanting. 5,000 years of human history teach one consistent lesson. Real money is anchored to physical reality. Fake money is anchored to promises. Promises can be broken. Gold cannot. If this video gave you a new perspective on money, gold, and the corruption hiding in plain sight, hit that subscribe button. History has the answers. The pattern is clear. The question is whether you'll see it before it's too late.